Can everybody see the CompuGrammer? Yes, no, maybe?
Yes.
Excellent. All right, so the way this works, I'll let you all answer the questions. I will pick the question, I will pick the answer that you all select by majority, and then we will review whether that's right or wrong after. And so we're going to get going with RESPA. So RESPA prohibits A, buyer from using their own attorney, B, buyer from receiving an estimate of closing costs, C, buyer from giving a bonus to an agent for an outstanding job, or D, lender from receiving secret profits or kickbacks from service providers. What does RESPA prohibit? A, B, C, or D? What do y'all think? D. All right, excellent. Now I know we have more people on the call, so that's only one answer. Oh, there we go. So D. All right. Anyone else want to venture into an answer there? All right, so D. That is correct. All right, I got you, Danielle. Okay, so yes, it is D. So RESPA prohibits kickbacks and services for services performed during the closing. So you can't get kickbacks using the RESPA. So that's what it prohibits. And that's pretty much the main thing it prohibits. It's, kind of the truth in lending, making sure that, money's not being passed around behind your back. A viable alternative to foreclosure would be filing a lis pendens notice, filing an attachment, filing a writ of execution, or a deed in lieu of foreclosure. A, B, C, or D? What do you think? D? Okay. Anyone else? A, okay. B, all right, we've got some varying answers on this one. A, B, and D so far. So that's 3 out of the 5. So we need a tiebreaker. Or somebody pick C. Who's our tiebreaker? Anybody? All right. Oh, another A. There we go. All right. So let's see. Drum roll, please. A is not the right answer. It is deed in lieu of foreclosure. It's D. So, a deed in lieu of foreclosure is given by the homeowner to the bank. So instead of giving them a foreclosure, they give them the deed so they don't have to foreclose, they don't have to foreclose on the property. So the attachment is filed with sheriff's office, prior to foreclosure. Writ of execution is filed with the sheriff, authorizing them to seize the property, and that's from the lender or the judge. And lis pendens literally means in lien or litigation pending. So it's just saying that it's pending litigation. So that's something filed against the homeowner. So your only option here is deed in lieu of foreclosure. So answer was D. Which federal statute requires a lender to give a borrower a statement of total interest being paid over the life of the loan? So a federal statute requiring the lender to give a borrower a statement of total interest being paid over the life of the loan. Regulation Z, Federal Fair Housing Act, Equal Credit Opportunity Act, or Fair Credit Reporting Act. Federal statute. A, B, C, or D? Anybody? All right. So we got an A. Okay. So who else? C. Okay. So A and C so far. A and C. All right. So you got Regulation Z or Equal Credit. So since Equal Credit was the second one, I'll pick that one. And that is incorrect. It is Regulation Z. So Regulation Z, and Regulation Z was the Truth in Lending Act, and I thought it had something to do with something else, but I'm remembering now. Requires the lender to disclose all costs in obtaining a loan. So Regulation Z is the right one. Equal Credit Opportunity Act was about providing the credit, not disclosing the credit. So that, you know, it's providing credit regardless of race, creed, or origin, religion, sex, etc. And then Fair Credit Act is about your credit report. So making sure the marks on the individual credit report is correct. So, and fair housing wouldn't have anything to do with lending. It would have to do with housing. So Regulation Z. All right. Which is a document that uses real property to secure debt? A promissory note, a mortgage, trustee deed, or chattel mortgage? A document that uses real property to secure debt. Which do you think it is? So B's have it. A mortgage. That is correct. All right, what type of note calls for interest payments only during the term of the loan with the principal due at the end of the loan? A wraparound loan, a term loan, an installment loan, or an amortized loan? So which one? So if it was a fully amortized loan, who can tell me what that means? If something was fully amortized. So amortization means that you pay off the full amount over a period of time, and the last payment is the final amount. So it's amortized over the length of that period. So if it's 36 months, it's fully amortized in 36 months. If it's 48, 72, whatever, 30, then it gets, that's an amortized loan. So then you got a term loan, installment loan, and a wraparound loan. So an installment loan, that means that you're paying on installments, but a term loan, think about what it's asking you. During the term of the loan, interest payments only during the term of the loan with the principal due at the end. All right, so you're saying, oh, wait, no, B, you guys said B. Correct, it's a term loan. So, amortized includes everything, principal and interest over the life of the loan. A term loan is paid each month and a lump sum principal payment is due at the end. Wraparound loan is when you combine two loans into one for an average interest rate. So you're wrapping those two loans together. And there's no loan called an installment loan because you're paying installments on any loan. So it's not actually called an installment loan, no loan. One form of seller financing is lease purchase, non-conforming, lease option, or land contract. So seller financing. So would it be a lease purchase, a non-conforming, a lease option, or a land contract? Which one would allow for seller financing? Would it be an option? So I got B and C, B and A. So I guess that's A, that you're a lease purchase. D, okay. All right. Yes, D. So land contract is the only one that you can do that's seller financing. Lease options and lease purchases don't actually finance the sale. And non-conforming means what type of loan it is. And if it's non-conforming, it means that Freddie Mac and Fannie Mae won't buy it in the secondary market. So that's what a non-conforming loan is. And then there's also non-conforming use and zoning, but that isn't about seller financing. It's about just what type of loan that someone has, non-conforming or conforming loan. So, again, land contract is the only one that's seller financing. Lease options and lease purchases aren't actually financed. They don't finance a sale. A lender advertises that there are reasonable monthly terms available for the purchase of a home. Which disclosure is necessary? So they advertise that there are reasonable monthly terms available for the purchase. Is it interest rate, and interest paid of the life of the loan? No disclosure is necessary, or only monthly mortgage payments? What can they advertise? What are they allowed to say? And if they say that it's reasonable, what do they have to do? Anybody? What do they have to do if they say reasonable monthly terms? So I got a B. So, I know all of us want to look good and be right. And that's the thing that everybody wants. And at the same time, we got to get through this material. So let's just throw some answers out there. We got 8 people on here and one person is willing to take a stab at it. Guess, throw something out there. There you go. Right. So B, C. So I got 2 B's. Let's see. Incorrect. So it is C. No disclosure is necessary because reasonable monthly terms doesn't necessitate disclosure in truth in lending. Now, if it's a trigger item, such as they say interest rate or monthly payments, then that will require full disclosure. But they're just saying monthly terms. Terms can mean a lot of things, but they're not specifically saying anything dealing with financing. So no disclosure is necessary. Just one day prior to a foreclosure sale, the homeowner pays the bank all past due payments, the late charges, attorney fees, etc. The homeowner saves the property under the right called equitable right of redemption, defeasance clause, statutory right of redemption, or anticipatory repudiation. These words aren't easy to say. All right. So, which one is it? There we go. So we got A's. A's. That's weird. Oh, yeah. Equitable right of redemption. That is correct. So, yeah, statutory redemption occurs after the sale. So, good job. Equitable right of redemption. And for those that didn't answer, that's your right answer. So, if the homeowner pays, just one day prior to a foreclosure, if right before the foreclosure they pay everything off, then they have the equitable right of redemption. What financing method does not use two ratios for qualification? Conforming conventional, VA, all of the answers listed use two ratios, or FHA? Who's got the answers? You ain't got the answers, Sway. You ain't got the answers. All right. Got a B? Anyone else? B and a C. All right. So maybe that's two C's. I think TJ put in a C too. So I'll go with C. And it is B. It is VA. Since VA actually does uses a residual income method in lieu of housing expense ratio. So VA is the only one that does something different because the residual income is what the veteran has left after paying taxes and housing expenses. So they use a different valuation when they're qualifying people for a loan. And a VA goes up to 100% loan to value as well. And I think they're 55% or something on DTI kind of thing. So VA is the one that doesn't use that. So it is, conforming conventional, FHA. Those both are going to use your 2836. VA is going to use the residual income method. Typically, a developer builder would have which type of mortgage on his development? Wraparound with a partial release clause. And remember, we just learned what wraparound is when you put two loans together. Interest only with annual payments due. So that would make a lower payment. They're only paying the interest with annual payments due. So, if they were doing a build or a development, that would save them the most money while they're building and be able to pay it off at the annual. Or a conventional fully amortized, paying it off principal, interest, taxes, insurance over the life of the loan, or a blanket loan. Which do you think they would use? All right. So looks like two B's and two D's. You guys are good with these ties. All right, who's going to be the tiebreaker? Got two B's, two D's. So interest only or a blanket? Nobody wants to break the tie? All right. I've been going with last one. So I'll continue that. And it is a blanket loan. So blanket mortgage is the right answer because interest-only mortgages is usually a very short-term loan with payments going only to interest on the loan. It covers more than one property. So if it's a developer, you want to get a blanket loan because you're covering multiple properties, and its parcels are released as they're sold. So, they'll release the parcel from the loan as you sell them off, but it covers multiple properties, and that's why they call it a blanket loan. And so that's what you want on that when it's a developer or builder. If it was a single house, that's one thing, but it says on his development, which would be different than the interest only. So flippers, people like that, working on a single house at a time, a lot of time they're going to use the interest only. A developer is going to pick up a blanket loan. All right, so we had some trouble with finance, so let's do it again. The term debt refers to an instrument used in many states in place of a mortgage, the amounts of money owed on a note or promise to pay, the transfer of real property by a private owner to a public agency, or the movement of money out of savings accounts into a higher yield investment. Which one do you think it is? So I got a B. B's, all right, B's have it. That is correct. RESPA regulations would not apply to the second or the subordinate lien for home equity loans, loans for 1 to 4 family residences, a transaction financed solely by a purchase money mortgage taken by a seller, or first lien regulation residential mortgages. So which one would it not apply to? And remember, that's a key point in your test, is they're going to put not or only or except. So make sure you're reading it correctly, because that's, lots of people get answers wrong just from the way they read the question. So RESPA regulations would not apply to. And think about what RESPA is. It's, it's your, okay, we got C. I hate that it jumps up. I wish the Zoom thing would just stay at the bottom so I can see who's all responding. So C's have it. All right. And that is correct. So only financed by federal related mortgage loans are the only ones that have to deal with RESPA. Which type of single mortgage loan exists when 2 or more different parcels of property are offered as security for the loan? So remember what we talked about before, 2 or more different parcels of property. So is it a wraparound, a blanket, variable rate, or fixed rate? A wraparound? All right. A's have it, wraparound. It is a blanket loan. We just talked about it. When it's 2 or more different parcels of property, it's offered, a blanket covers multiple parcels. Wraparound is just about connecting 2 loans together. So, a wraparound mortgage is a single mortgage that covers more than one loan is a wraparound mortgage. So you're covering the 2 loans, whereas a blanket mortgage is covering multiple properties. When a defaulting borrower redeems the property after foreclosure, but before the confirmation of sale, which instrument will he use? So that's defaulting borrower, and they redeem the property after foreclosure. Will they use a certificate of title, a sheriff's deed, a redemption certificate, a reconveyance deed? Remember, they've already defaulted. It's after the foreclosure. What are they using? I got a B. Anyone else? B, 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 B. Anybody, 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 anybody? Come on, people. There we go. There we go. All right, a B, a C, and a D. Oh, I love it. All right. Okay. Anybody else? So that's, and I wonder if Mo Sharif, if they're saying C, so that would be 2 C's. No, yeah, Mo Sharif already had a C in there. All right, so it's just 1 C, a B, a C, and a D. All right, well, I keep saying I'm gonna go with the last one. So it's a redemption certificate. It is a C. Way to go, Mo. So certificate of title, certificate of title transfers title by will. So, you know, that's a typical conveyance. And a reconveyance deed is issued when a deed of trust has been satisfied. So once they've actually satisfied the loan, when a deed of trust has been satisfied, they've satisfied the loan and paid everything off, that's when they would get a reconveyance deed. And then a sheriff's deed is only at a sheriff's sale. So a redemption certificate is what the borrower uses to redeem the property after sale, but before confirmation. So it's the redemption certificate, and that's what you would need to get the property. Okay. RESPA requirements would not apply in which situation? The property mortgage is insured by the FHA. The conventional loan will not be sold on secondary mortgage markets. The property mortgage is guaranteed by the VA, or a property is purchased with a federally related mortgage loan. So which would it not apply in? Remember, what does RESPA have to have? It has to be a federally related loan. So which one makes the most sense? So I got a B. B's. All right. That is correct. Because it's not being sold in the secondary market where Fannie Mae and Freddie Mac are the buyers, then it is not federally related. In a foreclosure sale, the debtor may be a successful bidder and be awarded the title to the property, may not bid on the property, advertises to secure exposure for the sale, is freed of any future responsibility regarding the liens. So we kind of just saw this as an option. So in a foreclosure, what can the debtor do? Again, this was something we just saw in a previous question. What were they able to do? So I got an A. Anyone else want to venture a guess? All right, 2 A's. That is correct. They can be an actual successful bidder and be awarded the property. A mortgage is recorded to comply with truth in lending regulations, transfer title to the mortgagee, create a valid lien, or assure amortization payments. So why is a mortgage recorded? What does that do? So I got a B and a C, B, a C, a B. All right. So I'm going to go with the last one and the one, oh, Somebody jumped in there. Let's see what it is. Another B. All right. That is incorrect. It is C. So a mortgage is recorded to create a valid lien. Because remember, the mortgage isn't the title. So when you're saying transfer title to the mortgagee, the mortgage isn't a title. It's recorded to create the lien. Once you sign, you're technically, it's not a lien. A mortgage isn't a lien until it's recorded. So that's how you do it. It has to be recorded to become a lien on the property, and it has to be recorded in the courthouse. The term debt service refers to movement of money out of a savings account into a higher yield investment, instrument used in many states used in place of a mortgage, amount of money paid in regular intervals to reduce the balance owed on a debt, or amount of money owed on a note or promise to pay. So a debt service, what does it refer to? Oh, C's have it. And you would be correct. The type of lender with the greatest percentage of assets invested in residential mortgage is A, mutual savings banks, savings and loan, life insurance company, or commercial bank. All right, B, savings and loans. Good job. A real estate firm has an in-house title company, mortgage broker, and home inspection company under one business entity. This is allowable only if the consumer uses the in-house lender. There is no duty to disclose these relationships to the consumer. Control business arrangements are clearly disclosed to the consumer, and the consumer is aware that the other providers are available. Fees are exchanged among the affiliated companies for referrals. C's have it. C's have it, and you would be correct. All right, did much better on it that time. All right, so let's go back. So that was financing. Definitely an area of practice. And remember, your big areas are financing, general principles of agency, contracts, and practice of real estate. So those are your big question, the ones that have the most questions for your test. 55 of the 80 questions on your national are going to be in one of those 4 categories. And then when you get to your state, remember it's license laws and rules of the Ohio Real Estate Commission, and then brokerage relationships. So your other 2 big categories, 30 of your 40 state questions are going to come from those 2 areas. So on a quick break for a second, let's talk about real estate as a practice. Beyond your test, what questions do you have as far as the business of real estate? Because in these, things we talk a lot about, getting through your test. Let's take a minute and talk about what it is that you want to know about the actual business, because real estate school teaches you the rules, but they do not teach you the actual way to get business and do business in real estate. So any questions on that? And if no one wants to ask questions on that, we can go right back to, the exam stuff. And at the same time, I want to give you an opportunity to ask any questions in regards to the practice of real estate and how to run your business. Anybody? Okay. Should we have an LLC? That's really a tax professional question. You don't have to. You don't have to have an LLC. And at the same time, I do. And I know a lot of people who do. it does protect you to a certain degree. Having an LLC that you run everything through allows you to do certain things tax-wise that you wouldn't be able to do as an individual. It also adds a level of security between your finances and, you know, anything that happens from real estate as like a lawsuit or anything like that. So it does give you a little bit of another level of protection to protect your assets. So, you know, it's definitely a tax attorney or a tax preparer question. And at the same time, it is something that, you know, a lot of agents do decide to go with just to protect themselves and to get better benefits through. Good question. Anyone else? So you all are good, huh? Ready to get out there and make all the money and do all the things? All right. Well, I guess we can get back to it if there are no questions. How hard is the test? Ah, it depends. It's one, you know, that's a relative question. It is a relative question, and that's the truth of it. It can be confusing. It's worded in ways to make it confusing, and there's several questions that will come up that you read and you think none of these answers are actually right based on what I've read in the book or based on what I saw in the class or whatever. None of these answers are right, and you have to pick one. You know, and it's one of those things where it's like you pick the best possible answer for it. But like, you know, they'll ask questions that, you know, when I came to Ohio, I was a practicing real estate agent. And there were several questions on there that confused me, and I had been practicing for years. And so, you know, yeah, because I overthought the question a lot of times and saw that it was asking a simple thing, and I was like, well, not in this case and not in practice, it doesn't work. So look for what is it? Occam's razor. The simplest answer is usually the best one. Yeah, overthinking. So take out the overthinking. Look for the simplest answer. The thing that I found was helpful for me was knowing you kind of know how many you're allowed to miss because you have 120 questions or whatever, and so you figure out what gets you a 70%, and that's passing. And then you flag all the ones that you're not sure of. You flag them on the test, and then you go back, count up your flags, and then you can be like, okay, you know, all the other ones I was pretty sure of, I'm sure I'm going to miss a couple of those. And at the same time, like if all these were wrong, would I fail? And then you just go back through and read those questions again. And a lot of times a future question will give you the answer to the question that you may have not been sure of, because they'll word it differently in another question, and it'll give you the right answer to the one you may have thought you weren't sure about. So best advice is just kind of go back through on anything that you weren't sure about, and, you know, make the right call based on what your thoughts are after you've gone through the whole test. You know, you did good today. Good. So, you know, and that's just it. You know, it's a matter of doing what you can, flagging everything. Yeah. And again, I get that, because it's like, you know, you get there and you're like, I'm not sure. I've had moments where, you know, I blank on everything. And as you see, even sometimes here, you know, I have my wife is going to take her test tomorrow, and, you know, she asked me certain questions. I'm like, I don't know. You know? I mean, it's one of those things where I don't. have I taken it before? Absolutely. I had to take a test. I've taken the two hardest in the country, actually. North Carolina is known to be one of the harder ones. It has a really high fail rate. I passed that one. And then Ohio, because it's not reciprocal with North Carolina, I had to come up here, take the full 120-hour class, and then sit for the national and the state again and take the full test over. So I've done Ohio and North Carolina. Oh, asking Sheree. Okay. Sorry. So yeah, you know, it's you know, just the thing is just like school in high school, a lot of this you'll never need to know again. And that's the shame of it. Because my wife was asking me about, tenancy and things like that. And here's the thing, I knew it all, but the rule is that I'm not allowed to advise clients on tenancy. I have to give it to an attorney. So why should I know it anymore? In North Carolina, sure, I was allowed to talk about it, but in Ohio, I'm not, because there are different rules in different states. So, that's the thing. It's like, yeah, you have to know all this, but then once it comes down to it, are you allowed to talk to your clients about? No. So, but they want you to know, because you have to have an overall understanding. So it shouldn't give you anxiety, Mo. It's just a test, and I know a lot of really great agents that had to take it 4 or 5 times, and those agents make a lot of money right now. So is it a hassle? Is it nerve-wracking? Sure. And is it worth it? Absolutely. Is it worth the trouble to go through and do it? Absolutely. Another one for Georgia after this, man. Why? I would ask the question, why would you get a Georgia license? Do you live there? Bi-coastal. So how much time do you spend there? Because yeah, it is pocket munching. Because here's here's the thing, because having 2 licenses is going to eat up some money, because you have to maintain those licenses in both states. You have to maintain your CE. You have to keep your CE up. You have to get your credits, your electives. You have to pay your board dues. You have to pay your MLS dues. And if you don't live there for any real length of time, it's better to just, refer that business out. You can, but you still have to maintain, in order to get it back out of escrow, you have to maintain it. You have to show that you took the CE. So again, it's one of those things like, is it worth it? I'd rather pick the state and then have a really good referral partner, because then I can, and that referral partner, you can say, hey, will you do 30%, 40%, whatever it is, or 25%, whatever you want from the referral, as long as you're licensed in any state, then you can, get money from that partner and they do all the work, but you don't have to be there, because it gets difficult. I held a North Carolina and Ohio license for about a year until I gave it up. And I said, I'm not going to hold North Carolina. I'm just going to have referral partners. I didn't spend any time there anymore, so I wasn't living there. So. Any other questions? And hey, if that works for you, do you, Regina? If it works and you got a plan in place and a way to make that work, absolutely. So any other questions about real estate in general? No? All right. All right. So let's see. It's only reciprocal in like 7 states. Hang on, I can show you if you guys are still looking at my screen. Yeah, Arkansas, Connecticut, Kentucky, Mississippi, Nebraska, Oklahoma, West Virginia, and Wyoming. So there are your states that it's reciprocal in. So let's see. Let's look at license laws real quick. We got about 10 minutes. If we work fast, we can get through it. All right. A person making an application to the recovery fund for payment must file an application to recover within 1 year after termination of all court proceedings. There is no statute of limitations on a claim against the recovery fund, 90 days after the termination or 60 days after the termination. A. All right. Excellent. Way to go. I like quick answers. That is correct. So 1 year. You have 1 year. A broker offers a seller a free trip to Hawaii in return for a property listing. What is true? The broker must disclose this in the real estate sales contract. The broker must disclose this on the listing contract. The broker must disclose this to any potential buyer, or the buyer and seller must agree to this inducement. So which is it? All right, come on. We got to be quick. 10 minutes. We got 20 questions. All right. So it is the listing contract. So because it's with the seller, it has to be on the listing contract. All right. So yeah, not the sales contract, the listing. So he need only disclose it between himself and the seller. He doesn't need to disclose it to anyone else. So only if it was an inducement to the buyer, it would have to be on the sales contract. From where does the real estate licensee get the 19 articles of the Canons of Ethics? The Division of Real Estate, the Ohio Association of Realtors, the Ohio Real Estate Commission, or the National Association of Realtors? Do 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 do. All right, we got a D and an A. All right. Anybody else? And a C. I love this group. All right, D, A, and C. All right, C came last. I'll continue with the who came last, and that is correct. All right, the association, the Real Estate Commission, because it's the canons. The National Association of Realtors does the code of ethics. So your canons are your law. So the Ohio Real Estate Commission does it. All right, excellent. All right, a buyer makes an offer to buy a house and faxes the offer to the seller in another state. The seller, upon receipt, signs the offer, intending to mail it back to the buyer the next morning. In the meantime, the buyer telephones the seller and withdraws the offer. What is true? There was never a rightful offer, as the offer was faxed and the seller must have received the original offer. There is no contract, as the acceptance has not been delivered to the buyer. Both parties are now bound to the terms of the contract, or there is a contract, as the seller has accepted the buyer's offer. Which is true? Was a contract formed? Was it conveyed to the seller? Does the, was it a rightful offer? Was a contract formed? This is a really important one. So I got a D. There is a contract. Actually, it's funny. It says contact instead of contract. D, anyone else want to jump in there? All right, well, we're going to go because we got to be quick. Oh, somebody jumped in. Let's see. B. All right. B was second. That's correct. All right. So, yes, no contract. So the acceptance had not been delivered to the buyer, so there was no contract at that time. Remember, it's conveyance. So just because the seller signed it does not mean a contract was formed unless it had been conveyed to the other side. For a minimum of how many years must a broker keep records? 1, 3, 5, or 2? All right, excellent. 3. Let's go. A buyer makes an offer to purchase a house and gives the seller until midnight, 3 days hence, to accept the offer. Prior to acceptance, the buyer withdraws the offer. What is true? There is a contract since the buyer made an offer. The buyer must wait until the end of the 3 days to withdraw the offer. The buyer is allowed to withdraw the offer anytime prior to acceptance, or the buyer may not withdraw the offer. What do you think? If you made an offer to a seller, B. Anybody else? B, 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 B. A. All right. So there seems to be confusion on what constitutes a contract. So I'm going to go with B since it was the first and the last. It is actually incorrect. The buyer is allowed to withdraw the offer at any time prior to acceptance. So a contract is only formed when it's been signed by all parties and conveyed back to the other party that was the original offer or. So once the seller has signed and conveyed it, that can be, as soon as they put it in a mailbox, that could be an email, that can be verbally conveyed, according to some courts. So, it's once it's conveyed back, then it becomes a contract. Just because you make an offer doesn't make it a contract. It makes it an offer. So you can always withdraw an offer prior to it becoming a contract. Now, once it becomes a contract, whatever the contract states makes the rules of how you can withdraw. So again, contract is only formed once all parties have signed and it has been conveyed back to the other side. After recording an affidavit of lien with the recorder's office, the broker shall provide a copy of the lien affidavit where a contract for sale or other conveyance of the lien property has been entered into to the. See, that's what I mean. I know what you're talking about, Sharita. That's why the questions are, yeah, right. Makes sense, right? That's why they're hard to understand. Oh, you were saying makes sense on the other one on contract. Yeah. So is it owner of the lien property, and the prospective transferee where known, or prospect of the transferee or the superintendent? C. All right. Prospect of the transferee. Incorrect. So it's owner of the lien property and the prospective transferee where known. So yeah, It states that when, Ohio Revised Code states that when a contract for sale or other conveyance of lien property has been entered into, after being recorded, shall be served either by personal delivery or certified mail upon the property owner. Because remember, the lien is against the property owner, so that's who they serve. So if it's a lien, it's against the property, and so they would give it to the property owner. And if it was being transferred to the prospective transferee where known. So that's why it's stated that way. Which of the following is not a management level licensee? Team leader, salaried licensed office manager, a new salesperson, or an associate broker? Not a management level licensee. Again, that's capitalized and in there. All right. Salaried office manager. Okay. So that would be, they would be, who else came in there? C. All right. C is last. All right. Great. That's correct. So it's the new salesperson because they're not in management. An office manager would be management level licensee. A team leader would be a management level, and the broker would be management level. So a salesperson would not be. If the superintendent pays any amount from the recovery fund in settlement of a claim towards the satisfaction of a judgment against a licensed broker or salesperson, the license of the broker or salesperson is automatically suspended. The salesperson or broker must pay a fine of $2,500. The license of the broker or salesperson is automatically revoked, or there is no action against the broker or salesperson as the fund is set up to protect the public. Which do you think it is? All right, this is our last question. We're at 9. We may be able to get one more, and if we get some answers on this, who's willing to throw one out? Take a guess. Superintendent paid the amount for the recovery fund. All right, D. Good guess. It's A. So it's automatically suspended. So if the superintendent pays an amount from the recovery fund in settlement of a claim against a licensed broker or salesperson, the license of the broker or salesperson is automatically suspended. So essentially, if the superintendent comes to the rescue to have to bail you out, you're automatically suspended. So if payment is made on your behalf from the recovery fund, you're automatically suspended, and you won't get reactivated until the broker or salesperson has repaid in full plus interest the amount paid from the fund on the broker or salesperson behalf. So if you're paid for, you not only get suspended, but you can't be reinstated until you've paid back the money plus interest. All right, last question. If given the choice, what type of listing agreement would a seller probably prefer? A net listing, exclusive right to sell, exclusive agency agreement, or an open listing? It's a good one to end with. I know we had some questions on this last time I asked this. Let's see how we do this time. C, B, anyone else? C and B? All right, I gotta go with B, even though it's C, because I had the rule that I set. A seller would prefer exclusive agency because if they bring a buyer, then they don't have to pay the real estate agent. Exclusive right to sell means that the listing agent or the brokerage gets paid no matter who buys the property. So exclusive right to sell, the broker would prefer. Exclusive agency, the seller would prefer. So that's how you look at those. All right, down to the last few. Well, I know we took some time to talk about some other stuff in the middle. hopefully it was helpful. There are some YouTube links and things like that. I'm not sure if everybody on this has gotten those before, but if you're interested, feel free to reach out to me via email and I can shoot those over to you. I don't have them on hand right now to pop into the chat, and I'm about to close out anyway. So yeah, if you're interested in any of the YouTube videos, anything like that, also remember these are all recorded, so you can go back and look at old ones and take a look at any videos or recordings of this that you want to catch up on. So enjoy. Let me know how we can help. We want to be of service for you. And you all have a good night.